Welcome to NATCCO e-learning, where learning online is fun and easy.
Overseeing the management of the most important resources of a cooperative is such a challenging task for board of directors and treasurers. For some, they say, money is the root of all evil. But according to Mahatma Gandhi, capital or money as such is not evil. It is its wrong use that is evil. So what is financial management therefore? Financial management is the efficient and effective management of money or funds so that the objectives of the organization will be accomplished. It is a specialized function directly associated with top management. Okay, so speaking of goals or objectives of an organization, as a cooperative, what are our goals, our objectives? Of course, financially speaking, we have to be sustainable, we have to be profitable, we have to be strong so that we will be able to deliver and provide quality services to our members. We have to specifically say that we have to safeguard our investments. We have to have liquidity. We have to have adequate returns. We have to have optimum fund utilization. We have to minimize the risk. So those are the objectives and the reason why we have to manage our financial effectively and efficiently. There are three key elements in financial management. Financial decision making involves decisions in investment, decisions in financing, and decisions in profit distribution. While financial control, this ensures that the businesses or the cooperative, is meeting its objective. This means that there will be regular evaluation and analysis of financial performance. Financial planning, on the other hand, is that the management needs to ensure that there is enough funding available at the right time to meet the needs of members. This means that they have to forecast, they have to plan, they have to prepare budgets, financial statements, and activities. So, in our business, a cooperative, a savings and credit cooperative, we are in what we call financial intermediation, wherein we're able to pool resources, money, from the members and then lend or re-lend it to the members. And there are risks involved in this kind of activity. Of course, the risk of default, the risk if the borrower is not able to pay. And there are other risks associated with this. So these are the challenges, these are the reasons that why we really have to manage well and as board of directors oversee the management of the funds of the cooperatives, because the fund is not by the cooperative itself but it is of the members of the cooperatives. So let's go to financial decision making. Under this element, there are also three sub-elements. We call it sub-elements. First is investment decisions, we have financing decisions, and we have dividend decisions. There are others probably, but the three are the most basic financial decisions that cooperatives are making most of the time. The first one is financial decisions. This includes decisions in investment, decisions in capital expenditures, decisions in delinquency, decisions in non-earning assets, and the like. It's good for us that we have standards. Our regulator has already provided us guides and standards in order for us to make right decisions on these accounts or on these issues. So later on in this module, you will be provided with inputs on the standards of these accounts. So number 2, we have financing decisions. In this decision, the board of directors, the manager, the management will decide on where to source the financing, where to source the funds. What are the terms? How about cost? So, as an example, the sources of funds of the cooperatives are savings, they have shares, they have borrowings, and some other sources of funds. The third one is not very common. and we call it dividend decision. Most of the cooperatives does not really make deliberate decisions on dividend. But it's very important that you have to decide how do you distribute your profit or surplus at the end of the year. Because out of this net surplus comes dividend for the members, and the other important factor is institutional fund, institutional capital, or the reserve fund. Let's go to investment decisions. What are the investment windows, or what are the options for the cooperatives to put their money? According to the standards, the first important decision on investment should be financial decisions and should be loans receivables. As a savings and credit cooperative, we have to make sure that the loans and the needs of the members in terms of loans will be met by the cooperative with superior quality, of course. The next one, it could be financial instruments. They could invest in other securities, banks, and other savings institutions. Of course, the federation is also a window for financial investments. For other type of cooperatives, like the multi-purpose cooperatives, they have what I call non-financial investments. Non-financial in the sense that it's not involved with financial activities like the store, they invest in schools, they invest in other type of businesses aside from the banking business. So these are good investments, but if you are not able to manage those are very, very risky. And if you don't have expertise on those will not give you the optimal returns. So the next one is financing decisions. Under these decisions, what are the sources of funds of the cooperative? In the list, we have savings deposit, we have share capital, we have borrowings, we have probably project funding institutions, and donations and grants. In this order, this is the most effective way of sourcing your funds. Savings, because your members need savings, needs a place to put their savings. And share capital, a place to put their long-term investments. Down the line, these funding institutions and even donors are recently no longer a good source. We can no longer find these institutions unlike before. That's why the effort of the cooperative should focus on savings and share capital, because a lot of members out there doesn't even have their full savings in the cooperative. They have to be educated, they have to be taught how to save and how to do thrift, so that they will be able to prepare for the future. So as board of directors, we have to manage this decision. How will we source our funds? How will we grow? Where will our growth come from? It should be in the order of savings, share capital, borrowings if necessary, project funding if they are available, donations if there are available. The third one is dividend decision. Under this decision, you have to consider two major important elements. The first one is the institutional capital. This is the reserve fund of the cooperative. The standard says you have to have 10% reserve fund, 10% of your total assets. The second important element is the dividend, or the interest on share capital. Under the standards, the dividend or the interest on share capital should be at market rate or at least above inflation rate. Looking at the net surplus allocation, the law says the reserve fund should be 10% of the net surplus minimum, meaning it can be increased depending on the need of the cooperative to achieve the standards. So if your institutional capital, if your reserve fund is low, if it's less than 10% of your asset, You have to allocate more from your net surplus so that you will be able to achieve the standards. And the standards it's not there for itself. It's there to make sure that the cooperative is strong and the cooperative has enough reserve so that whatever happens, general risk will come into the cooperative. The cooperative can sustain the operation under the risk. The next one in the net surplus allocation is the optional fund. This one is 7% of the net surplus maximum, meaning it can be decreased. Once you increase the reserve fund, you can adjust the others. Okay? The next one is the CDF, or what we call Community Development Fund. It's also 3%. And the CTF, or the Education Training and Cooperative Education Training Fund, it's also 10% maximum. The remaining amount of the net surplus can be divided into interest on share capital, or what we call dividend, and patronage refund. So, going back to the standards of institutional capital, which is 10%, you have to allocate more to institutional capital. Therefore, the dividend, or the other part of the allocation, will decrease. So this is a decision that the board of directors should look into and should take into consideration, because if you don't deliberately make great decision on this matter, you will not be able to achieve the standards, and you cannot compete with other institutions as far as dividend and reserves are concerned. So to have a recap, we have financial decisions. What are the sources of funds? We have the savings, share capital, external borrowings, project funding institutions, donations and grants, and the reserves. On the other side, what are the uses of funds? The co-op use it for loans, investments, long-term or short-term. The co-op will use it as a liquidity to be able to cater to their day-to-day operation. They have non-earning assets and non-financial investments. When do you increase the savings? When do you increase the sources of fund? When do you deliberately increase the loans? When do you deliberately decide for borrowings? So we have to be guided by the financial structure standards. Okay? So we have here assets, and this represents the uses of funds, and the liabilities and equities, which are the sources of funds. According to the standards, sources of funds, which we discussed a while ago, savings deposit should be 55 to 65% of the total assets. And the share capital should be 35 to 45%. Borrowing should be decreasing or zero. Okay. On the asset side, these are the uses of funds. The standard says the loans receivable should be 70 to 80% of the total assets. And the others can be other investments. What is important also, that in the asset side, we have earning and non-earning asset standards. So the upper group represents the earning assets, and that should be 95% of the total assets. The lower group represents the non-earning assets, and it should represent only 5% of the total assets. And why are they called non-earning? Although they're important in the business, they have to produce cash. But this group of assets does not produce cash. That's why they are classified as non-earning assets. The more you grow the business, the more you grow your assets, you have to decide where you grow. Is it earning or non-earning assets? Is it the savings, the borrowings, or other sources of funds? And you have to be guided by the standards. In the sources of funds, a while ago we discussed about the reserve fund, the institutional capital. That should be 10% of the total asset. And that is coming from the net surplus allocation which goes into the reserve fund of the cooperative. So if we look at the relationship of the two sides, the uses of funds and the sources of funds, we can now see the result. After pricing decisions, we can see what is the contribution of the loans receivable and the investments to the income. And that's what we call interest income. You have interest income on loans receivables. You also have interest income on your investments, whether it's in the bank, it's in the federation, or it's in other investment institutions. You also have income if you have other investments that are non-financial investments. So when you have multi-purpose activities, you have income from those. But those are not interest in a form of interest. Those are probably sales, service income. So we call them for this presentation non-interest income. Of course, you have also other income, miscellaneous income. Regarding the cost or the expenses, your uses of funds has cost. So for example, savings deposit, you pay interest on savings deposit, interest expense on savings deposits. For your external borrowings, you pay interest expense on your external borrowings. And for your non-earning assets, you have also other operating expenses. You have depreciation for your non-earning assets. So this comprise now your income statement. Of course, we add to that the provision for probable losses if you have risk in your loans receivable. So if we now total the income that will represent as your gross income, then you have your expenses. The difference of your income and your expenses is what we call net income, or in our language we call it net surplus, which we will divide to the members and to the reserve fund of the cooperatives. So when we say financial control, we think immediately of policy. How do you control your financials? Of course, you have to have a policy. And what are the topical areas of a financial policy? These are just suggestions and the common topical areas of a financial policy. So we have accounting for cooperatives, we have financial reporting, internal control, petty cash, cash shortages and overages, cash advances, authorized signatories and approvals, investment, fixed assets, general purchases or bidding policy, asset required in settlement of loans, charge-off and recovery, external borrowings, share capital, dividend and patronage, interest rates, budget policy, retirement fund, internal audit, and risk management. So these are sample topical areas that a cooperative should have in their financial policy. So now, what are the roles of the board of director and CEO in an accounting system? First, if we trace the whole of the cycle of the accounting system, we have the transactions. The transactions are being recorded on a daily basis. And then, after the transactions are recorded, and this is what we call bookkeeping, the transactions are then classified, summarized, and made into financial statements on a monthly basis. The system or the computerized accounting may help the cooperative do all these tasks. At the end of every month, the financial statements are then analyzed, approved by the manager, and analyzed through the ratios. And then the internal audit may look and check these financial statements, and at the end of every month, the financial statements will be submitted to the board of directors. At every month meeting of the board of directors will analyze and will look at the financial statements and the financial ratios vis-a-vis the standards of the financial ratios. And then we'll again review and look at their plans and directions so that they will be able to achieve it at a certain given period of time. Okay, so how do we now differentiate the bookkeeping and the accounting? Bookkeeping is just a part of accounting, because bookkeeping, it is the recording phase of accounting. It ensures that all the financial transactions are being captured in the books and our balance. And this is what we call double entry bookkeeping. Accounting, on the other hand, is the process of recording, classifying, summarizing financial transactions, and interpreting the results thereof. So when we say bookkeeping, the books of accounts being used are general journal, cash receipts journal, disbursements journal, and the system is able to capture all of this. While accounting, bookkeeping is just the first step: posting financial statements, financial ratios, and financial analysis. In other words, accounting is broader than bookkeeping. So what is the accounting system being used in a cooperative, and how does it differ from other types of business organizations? In the cooperative, we are using the modified cash basis. And when we say modified cash basis, it is in between the cash basis of accounting and the accrual basis of accounting. Cash basis accounting is where you record all your cash transactions. If there is no cash transaction, there is no record. So the revenue is recorded and accounted for when there is actual cash collected, and expenses are recorded only when there is actual cash disbursed. So that is cash basis accounting. The accrual basis accounting is the exact opposite, the extreme also of the cash basis. It is when the revenue is recorded when it is realized or earned, even if the cash is not yet received. So if you deliver a revenue today and you haven't received any cash, you can record the revenue as long as it is already earned. On the other hand, the expenses are recorded even if you have not yet paid the cash, as long as your expenses has been incurred. In other words, it doesn't matter where the cash went out or in, as long as the transaction is consumed and incurred, the transaction is being recorded. So why cooperatives are prescribed as modified cash basis for accounting? First, what is modified cash basis accounting? Modified cash basis accounting is you record only revenue if you actually receive cash. Second, you record expenses if you incur the expense, even if you don't pay it in cash. Third is you record liability when you incur liability. And fourth, you record provision for probable losses, and you also record for provision for the depreciation. In other words, in the cooperative, you are more conservative in revenue, such that you record only revenue when there is cash. On the expense side, you record expense even if you don't pay cash. And what is the reason behind all of this? It's because of the annual dividend distribution. We are conservative with the revenue because at the end of the year, all of our income is being returned and allocated to the members into the statutory reserve funds. So the COP should make sure that all the revenue collected during the year are in a form of cash. Otherwise, they will be distributing dividend that has no cash receipts. Okay. So let's now go to the financial control cycle. This is the cycle of 1, 2, 3. First is the documenting the past performance. Here you are recording the transactions that has happened in the form of financial statements. So we have the basic income statement, balance sheet, statement of cash flows. Number 2 is analyzing the past performance. Here you use trend analysis, you use ratio analysis, and you use benchmarking. The third one is predicting the future performance. And here you are talking about the cash budget, the business planning, and the strat planning. So this is the cycle. All year, all the life of the cooperative it's happening all the time. Let's go to the first one, documenting the past performance. What are financial statements? What are the basic reports of a cooperative? We have the three basic reports, the balance sheet, income statement, and cash flows. What are the credit management reports? We have the aging of loans receivables, we have allowance for probable losses, and we have report on recoveries from written off accounts. And what are marketing management reports? These are membership reports, savings and shares build up, results of marketing campaigns and activities. And of course, the financial ratios reports. So these are the basic monthly reports of a cooperative. You may download some of them below. And now, you may proceed with the workshop. Thank you!